Good evening, everyone. We are live from Chicago. Today is Thursday, June 13th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are glad you are with us. Technically the last show of spring. Summer starts in just a few days. Here in Glen Ellen, Illinois, the western suburbs, we have tons of cicadas and we have tons of heat. So I hope things are a little more pleasant where you are, but we're going to get started and it's going to be an exciting night. We're starting off with the theme of today, which I'm labeling the indefatigable. And yes, the very first sentence I have is the word of the day, the indefatigable. That's referring to the stock market and summer thoughts. Be interesting to see what you guys think of what's going to happen through the summer and then into the fall. If you are new to the program, please subscribe to us on YouTube, click the little bell, and you'll get notified every time we go live. And also when I upload a video, if it's not necessarily live, follow me on Facebook, on X, and LinkedIn. We have a pretty big audience there and hope that you guys will see that I tweet pretty much every day and sometimes a couple times a day when there's big media events happening. Big show tonight, our usual chapters, and except the difference is we're going to move the AI section up right after my opening remarks on the monthly market review. Really excited to have Karan Kumar with us from Toggle.ai, the preeminent firm in financial management AI development. I've been using their product for over a year and they're a relatively new company. So I hope you guys will really tune into this. You know from I'll go back to on camera here. You guys know from the investment section that I talk about our risk management controls, and I spend a lot of time on that because risk management is very, very important. But idea generation has radically changed from the 80s and the 90s with the Bloombergs and the FactSets and the Refinitives and all that. And Karan will be here to tell us about that. It's really exciting to me. I would like you guys to give him a big welcome when we get to that segment in 10 minutes. And then just start typing your questions. You don't have to wait till we're done or anything. Just if you've got questions, you want to know how we're using that idea generation here at CB3 Financial, he'll be happy to tell you what they're doing, and I'll tell you how we're incorporating it. Our next show, put it on your calendar, is already after the 4th of July. It's Thursday, July 11. Now, this next slide really has nothing to do with the show, but because we have so many people returning to us from LPL, last count, I think it's 27 with another 5 in the queue. Online brokers are seemingly a dime a dozen, but a lot of people have said, you know, we've come back to you and you're using this company, Interactive Brokers. Well, they're the number one broker for the 6th year in a row in 12 categories. So take a screenshot of this. I won't spend any more time on it, but that's why we're with them. We're always looking out for you guys, want the best possible brokerage firm we can find on that. So the monthly market review stocks rebounded in May, and now you can see it's continuing to June. I mean, even today, the S&P and the NASDAQ hit yet another new high. The Dow is sputtering. There are reasons for that. We'll get into that a little bit later on. Small caps also performing on par with large caps, which they have not done for most of 2024. And in fact, on our buy-sell signal, the small cap IWM is still on a weekly sell, whereas we are clearly long in our portfolios. So we obviously aren't making big decisions based on the small caps, but we would like to see more breadth, and we'll get into that in the rest of this section. So it's yet another solid quarter of GDP growth. And we see earnings per share estimates continuing to climb despite the worry wall. You've heard me say in past times, climbing a wall of worry. Well, that's the infamous worry wall that the news media in this country creates. And they do that so they can get eyeballs on the screen. They do not do that for your best interest. I think in some ways they're conspiring with big brokerage firms to get the small investor to sell their shares. All right. And then, the big industrial firm, big institutional firms pick it up at small prices. All right. So today's market sentiment almost apathetic compared to the frenzy of the late 1990s. Why is that? So the 1990s led into 2000, obviously the first really big crash in most of our lifetimes. Certainly 1987 was also big, but 2000, the valuations of all these tech firms. But what we're going to see, and you'll see that with Toggle, I mean, they have deliverables. This company's just been around in the forefront. We were just talking before in the green room before we started the show, literally months. But companies back in the 1990s did not have earnings. They were just going because they were .coms and selling, and that's why the market ended up crashing, especially the NASDAQ. But this weak breadth is something we're paying attention to as your portfolio manager, because it's inexplainable that we can continue to do this growth if we don't get sections like the small caps and, in this case, the Dow, the stalwarts there, keeping up with what the NASDAQ is doing. And I'll show you that in just a couple slides. So we're on, I think, 4 or 5 new highs in a row for the S&P and the NASDAQ, hence the word indefatigable, okay? So market breadth has become weaker, meaning we would like to see in a strong bull market all sectors of the market participating. There are 11 sectors in the S&P 500, and then there are other spaces such as small caps, high tech, etc., that are industry groups, if you will. But this is what it looked like in 2010 to 2019, that decade. Basically, the return gap between the Russell 2000 and the S&P 500 widened. And we're now seeing that same ratio. And I'm not concerned about it yet because there's so much strength in the mega cap stocks, the Magnificent Seven, obviously, that we know about. And because I'm seeing so much just rip-roaring technology developments from small companies like Toggle and others. But eventually, we're going to have to see the whole market participate. And when you look at the screen here, this is I would say a normal distribution on a normal day. The green bars are sectors that are going up. You see consumer discretionary, industrials, and then technology. This is just a random day. It doesn't matter really what day it was, up 2.3%. But realize that the technology sector is now 31% of the entire S&P 500. The top 5 stocks represent over 50% of the weight of the S&P 500. So the winners are getting richer, and the losers are either dropping out of the S&P 500, which is happening, or they're scrambling to catch up. This is why technological innovation is so important. That is why I have our guest on tonight to talk to you. So on this next slide, look at these 2 charts, and you'll see these are different days, all right? Technology still number 1, and yet 9 of the 11 sectors are negative, and yet it was still a positive day for the overall market. Why? Because technology was up 1.85. I don't know what happened that day. It might have been just NVIDIA. It might have been Apple and Microsoft all come together. We had Avago, Broadcom, come out today with a 11% spike, which pushed up the NASDAQ. At one point, the NASDAQ was up 200 points, and the Dow was down 180. So that bifurcation, second word of the day, but I've used bifurcation before, so it's not really going to qualify as word of the day. But that bifurcation is what we're continuing to see. And it's going to happen until some of these legacy companies decide to make the investment in technology that these emerging firms are doing. And that's, again, why I'm so excited about our interview tonight. You guys know this chart. This is the 100-year chart of the S&P 500, the 3 secular bear markets, 3 secular bull markets. We're in one that started on April 10th, 2013. You see it breaking out of that red box there. You guys know the chart. And we're just continuing on to make new highs. I continue to believe that this secular bull market has enough legs and power based on historic data to last another decade, at least 8, maybe 10 more years. So I know that the stock market isn't the economy, but it is the most prominent and most frequently updated benchmark of financial and economic performance. So we've had these 27 new, in 1 year, 27 S&P new lifetime highs, and the NASDAQ is almost that many. The Dow is not, I already mentioned that. And this growth is happening despite geopolitical, economic challenges. You saw just hours ago that the G7 finally agreed to send support to Ukraine, substantial multi-billion support, multinational support. And I'm not saying whether I'm for that or against that, but that sort of geopolitical tension doesn't help the market participants, and yet they're just ignoring it. And they're going ahead and they're continuing to develop and continuing to turn in record sales. We have another new high in our U.S. debt at $37 trillion. But what's the market doing? The market's doing nothing. You're going to see in a future segment tonight that corporate America has figured out a way to finance this debt. And I don't mean finance the debt themselves, but they're financing their future transactions with higher interest rates and still managing to show substantial profits, which is why their earnings per share is going up, which is why their stock prices are going up. All right. That's the way that's working. So the secular bull market does make a difference in this old adage that you want to stay, in the market, certainly through May, but the sell in May and go away just does not take as much validity right now as it does in a secular bear market or even just a flat market. But this tendency to be weak from May through October, I mean, imagine if I had paid attention to that and taken you guys out of the market. You are 100% invested in CG, GI, and DS, 100%. A little bit of cash in there, but I mean, we're going to call it 100% invested. You just can't do that. You follow the signals, and some of that is just being tenacious and staying on a systematic program, all right? So if you ignore the high-profile AI disappointments, obviously NVIDIA has not been a disappointment, but there have been some others. SMCI, semiconductor company, dropped 18% at their last, earnings report, and we dropped them from the portfolio and brought in a new player. I mean, that's just what we're doing. It's just the way of the world right now that there are going to be major disappointments, and you don't have huge positions in small companies unless you're willing to take big hits. Someone in the chat said earlier, be sure to mention that NVIDIA is a great company. Well, of course they are. We know that. We have a 16% position, the largest holding I have ever had in any of our programs. Most of our holdings are 3%, as you probably know from looking at your CG statement. But DS is a different, a little more speculative program, and 16% right now is what we're holding in NVIDIA, and it's really paid off. So as I mentioned earlier, corporate America has become used to navigating this high interest rate environment, and it's learned to do it well. You can see the trend continues higher for revenues. Look at the parabolic nature of this chart, even through this high rate environment. And the bulk of U.S. companies have reported, in fact, in the chart I'll show you on the next page, there's just 2% left. And this marks the strongest growth in nearly 2 years, again, at a time when the corporate media would say you need to be scared and hiding under a pillow. Don't listen to them. That's why you watch our show, all right? So this is how we close this section. You guys know this chart. This is a Refinitiv chart where I show the percentage of stocks that are beating, companies essentially, that are beating their earnings estimates. And we've got healthcare at 89%, industrials at 80%, technology at 90%. Only 2% of the companies in technology even matched. There were just 8% below, but 90% beat. I mean, those are just great numbers when just a year ago, corporate America was saying it's going to be a single-digit year. It doesn't look like it right now. So, all right, guys, get ready. I see, I'm just looking in the chat. Did I miss anybody here? Debbie, yeah, I know it's soggy. It's soggy up here too in Chicago. So, guys, AI is changing everything about the way we live, and it's happening quicker than I think any of us realize. So I've got on the screen here a shot where you can just see the plethora of different areas that are affected. So here's Fox News Sports saying, we're going to use AI to highlight the highlights, okay? They've got a real glove and then an AI, robotic hand there holding a football. Models being replaced by images. Now that's, something we've seen even months ago. AI in our smart homes. Here's a kid, child, very young child, learning on their laptop, and the images are being projected there. Hey, David from Missouri, glad to have you online, sir. Even in agriculture, for someone with a laptop and figuring out how their crop is going to have a heartier bounty there. But you guys, I would think, want to know how we're using AI in what we're doing here. And so that's why I've asked Karan to join us. So Karan Kumar is a senior member of the product team helping to drive innovation at Toggle. So Toggle is this AI-powered investing program. They have a program called Copilot, which is what we started on, and they've sort of migrated that to their pro system, and now that pro system is migrating to their terminal system, which is, you'd think that this is like a 5 to 7 year product curve here like Apple. This is literally just happening in single or double digit months. It's amazing to me. And again, I've been with them over a year, so I'm seeing this. So there are ex-hedge fund managers like Stanley Druckenmiller. He's in the Market Wizards book. You guys know Tom Basso, who I've interviewed on my show. He's my personal mentor trader. So we are super excited to have Karan with us now. This is his first slide, but I'm actually going to talk on it because I don't think he would want to crow about it like I'm going to. Look at the awards that they've won. This is like 5 to 7 years of awards, except that it's all within 1 year. Benzinga, okay, Wealth Nation, US FinTech, Singapore FinTech Festival, FinSum. I mean, this is just really, really exciting technology. So I would like you guys to give me a hearty CB3 welcome to our guest tonight from New York City, Karan Kumar. Karan, good to see you, buddy.
Hey, Charles. Thanks for having me.
Oh, absolutely. Wouldn't miss it.
I have to say, you're great on camera. I'm going to try and be as good as you.
Well, this is actually not, I'm in the next room. This is just my image. This is a holograph. So Karan and I dialogue a lot on this because for whatever reason, I've ended up being a beta tester for a lot of companies, including Bloomberg and Thomson Reuters and Refinitiv and et cetera, because I like finding bugs. Orkins never wanted to hire me, but you get the point. So I love emerging technology. I just do. And so what we're going to talk about tonight, and Karan, I'm going to take it over the next slide and send it to you and just tell us a little bit. But before we switch to that, tell us a little bit about you. So you're obviously a really young guy. You're in an incredibly fast-moving industry. How did you end up here, and what prompted you to be interested in Toggle? Is it an interest in financial services as it applies to AI, or AI as it applies to financial services? Those are kind of two different things. So.
Yeah, well, it started with an interest, I think, in general finance. I was a trader myself. I think as a lot of people over 2020 during COVID, we saw that boom in retail trading. I found myself opening a Robinhood account, trading all those meme stocks and doing an analytics background at college. It just kind of all fit together that I found myself at Toggle, and things took off from there.
Yeah, that's awesome. All right. Well, I've got the first slide up here. Actually, let me go backwards here. I think, yeah. All right. So there's the problem, is the investment analysis process is broken. And Karan uses a phrase with me, and I kept thinking, you guys know when you go to the doctor and he's hammering around and oh, that hurts. Because, and it's like, oh, it's like, but I have to do that, sir, because I need to find your pain points. Well, what I like about Toggle is they're looking for pain points, and we have them in our industry. And one of the biggest ones is this data vomit phrase. phrase that I've used before, and it's not unique to me. There's just too much to process. So that was a pain point. And the other pain point is just not having the time to commingle a bunch of different technologies and looking for a singular platform that can give us what we need efficiently so that we can get back to doing what we do, which is actual trading. So tell us about this, Karan.
Yeah, I think you hit it right on the on the head, Charles. Is that our founders were just, I guess, overwhelmed with the amount of data that was there in order to make decisions, that they decided, hey, is there a way for us to kind of take this mountain of data, cut out the noise, and just pull insight from it? And that's where Toggle Copilot was born, which you have been a user on. And as data overload increased, we saw an increase in unstructured data, right? We're talking big data, we're talking things like tweets driving financial analysis, right?
Right,
Just
sure.
the type of data and the growth of that data has just been exponential. We found ourselves saying that, hey, is there a way for us to pull in even more of this data to make even more insights? And that's where the terminal came around. And
And of course, so
what
much of that
power
data is uncurated. It's just, I hate to use the term again, but it's just vomited at us because of some search engine. But you guys are curating it in a real specific way.
Absolutely. And that's thanks to the knowledge graph that we have powering the system. So, what the knowledge graph essentially is, it's a web of information that kind of takes everything you need to know about a single entity across different sources. Let me give you an example.
You want me to go to
You
the
look
next
at
slide here and actually show your, because we can see the brokenness on this with these legacy sources and just tons of gears and things. So,
Yeah. So like on this, right, you see Bloomberg, you see FactSet, you see Refinitiv, you've got the news, you've got socials, right? Then you've got things like charting, right? Summarization, screening, right? How do you take all of this and pull it together to give you that insight? That's where the knowledge graph helps. And just to give you an example of how that knowledge graph works is
okay.
you look at a screen, right? You see Apple, right? You just see Apple, okay, one of the largest companies in the world, right? The iPhone producer, whatever. What does the knowledge graph see? The knowledge graph sees all the exposure Apple has to other companies, countries, events, news, so that, for example, when it gets a news article and it reads the news article that says, hey, ChatGPT is now going to be included in every iPhone, it knows that, okay, now the connection between NVIDIA and Apple is a lot stronger. So that now I can
Right.
start alerting my investors when there's something going down with Nvidia. It might have a bigger impact on Apple than it historically has, and
Now,
that's
because
all.
Microsoft owns a portion of ChatGPT, I would think it would then bring that in. We talked about this in the green room too, about the tentacles of what
Yes.
a toggle terminal does. So it's kind of like an octopus. It just goes out. So you've asked for information here. I think I'm on camera, but now we're pulling in here and here because these are influencers that essentially inform what could be happening with the target stock that you're looking at.
Yeah, yeah, and not just talking about one stock. You can even do it on a portfolio basis, right? So we have one of these tools. It's called a summarization assistant. What it does is it can summarize the performance of your portfolio in one day, looking at all these nodes. So looking at articles, news articles, looking at 10Ks, 10Qs, looking at competitor analysis, right? And pulling all of that together to just give you a single, simple write up of how is your portfolio performed today, what could happen next.
Yeah. Well, I have the slide up here of the discovery, analysis, and monitoring, and I'm comparing it. I'm just going back to the other one with all the gears and wheels and visualization and watch list alert. That's just kind of a blithering amount of data. Talk about this graph a little bit, and then the knowledge graph, which is what you've been talking about, which is the center of this circle.
Yeah. So what the knowledge graph does is it ingests all sorts of data. Bank reports, 10Ks, 10Qs, analyst reports, news, to try and pull out what is the most important information you need to know. It then uses that to identify all the nodes an asset has exposure to, competitors, suppliers, vendors, so that if there is, let's say, a big shift in a small port out of Ukraine, the system can understand, okay, what impact does that have on a mega cap like, or sorry, a large US stock like Caterpillar, right? Like, but
Sure.
that connection is what the knowledge graph is able to identify. And what's really cool is that it's self-evolving. So as it gets more information, it's able to say, okay, I see this. And then as it get more and more information, it says, okay, what I caught previously is actually a lot more of a legit relationship than previously believed, right? So it has this identification of nodes as well as ensuring the validity and robustness of that relationship.
So, two things I'm hearing from you. First of all, this is generative AI in its quintessential state, generating further ideas. But it also has occurred to me, and literally just now, folks, that you mentioned Caterpillar. If I'm looking to buy Caterpillar, you go out and do some research and find out they're in, in a big contract in Ukraine or France or somewhere, but there are 3 domestic European companies competing on that. I may hold off buying that. So it's not so much tell me what to buy. It could tell me what not to buy. If not getting that contract because you had those tentacles of knowledge on Caterpillar, that's not going to come from any kind of search, any kind of typical search.
True.
It might say, there's future risks there, and all of a sudden you wake up and they're down 10% one day because that contract went to a local European company. I'm just making something up. But this could apply to oil fields. It could apply to airlines, anything.
Yeah, and that's the beauty of having another assistant we call our screening assistant. And what our
I'm going to
screening
go back to
assistant
that now. Yeah.
Yeah, so what the screening assistant can do is it can identify all the companies that have exposure to a certain theme, and then you can then filter that down further by financial indicators, right? And everything I've talked about so far is all triggered by a large language model. So you don't even have to point and click anymore. You just have to ask the question and you let the research come to you.
Yeah, then we've talked about this. And guys, go ahead and if you got any questions, put them in now because we're getting kind of near the end here. And I know there's about a 30-second delay. There's so much. How do people learn to use this? And obviously the retail people, for the most part, that are on my show are probably not going to use it, but they want to know how I'm going to use it. Mm-hmm. So speaking to the computer, I mean, I'm wearing glasses that are by Meta that I can talk to. And in the last show, I took a picture of one of the people on the show and I sent it to her and she got it. Well, we're still on the show. This is one step closer to talking and telling a computer what we want and letting it not constrict us with, we're used to prompts. I mean, let's face it, Bloomberg started with just DOS prompts, right? And if you get a command wrong, something space, semicolon, you don't get anything. But you guys seem like you're going to a place where it's the human voice that's going to direct what the research is.
Absolutely. I think throughout the time, as we've been developing this, we're not trying to replace anyone here. We're trying to help them do their job better.
Yeah. And right? I honestly have never felt the least bit threatened by AI. I am way, way more excited because I don't see... there has to be a buyer, and you guys have seen this. I'm looking at the camera now. I've told you this. For every buyer, there has to be a seller. If I'm wanting to buy and nobody's wanting to sell, trade's not going to happen. If somebody wants to sell and there are no buyers, it's an emotional process. I think, at least in my lifetime, we're not going to see AI conquer that. I mean, it's just not. But what it can do is shave hours a week off of my life so that I can focus on the things that really matter, which are accurate trading, using risk, parameters that we've set up and doing them accurately. So
let me give you an example of that, Charles, right? So like every holding in your client's portfolios, right? The system can go through the 10Qs, the 10Ks, the earnings transcripts, and just give you write-ups of everything that you need to know so that you don't have to go through and manually read each one. The LLM can even read charts. It can read tables. So now you don't even have to open a PDF anymore. You can just ask questions about it and get your answers.
So if you just say, look, is this stock trading above the 20 exponential moving average? It reads the chart and tells me that.
Absolutely.
Without having to call up a chart. That's huge. I have on the screen now this, on the left, which we're calling AI vomit. And then on the right side, talk about what you're doing here on the right side. So what happens to Exxon? That's Exxon there. If oil prices fall 10% in 1 week. And then there's this median range. And I've shown this chart before, not this exact one with Exxon, but with other stocks. But talk about how this is on this screen here.
Sure. So the output on the left side is from ChatGPT, showing you what is it believe is going to happen to oil prices when, what's going to happen to Exxon when oil prices fall 10% 1 week. And it's a very basic answer. And like you said, it's word vomit, right? It's such a long response for you to kind of go through and weed out what is actually important versus just asking Toggle on the right side, what happens to Exxon if oil prices drop 10% 1 week, giving you an actionable insight. Hey, we've seen this happen X many times in the past. Here's how Exxon typically reacts to that.
Well, specifically, because it's really tiny on the screen, but I want you guys to see. So when we ask this question, since you asked, Toggle says, historically, this has actually occurred 79 times, totaling 273 trading days, because some of these events are longer than others. ExxonMobil, price moved, after 79 episodes, and then there's a range down at the bottom. So there's a range of expectancy, I believe, is where you're saying, based on historicity here.
Mm-hmm. Yeah, basically. And what it's trying to tell you is, unlike that basic, I guess, understanding of, okay, oil prices are going down, revenues are going to fall, Toggle's telling you, hey, that's actually already baked in historically into the stock. That's why it typically tends to rise thereafter. But right, pulling that quick insight allows anyone to essentially be an investor.
Yeah, it's a simple question like, okay, if the market drops 5% in a correction, which sectors are most likely to be hit? I mean, that's something that would be real helpful for all asset managers. And of course, everybody would react to that differently. Some might say, well, I'm a dip buyer, so I want to see when that drop is so I can go in and buy. Others might be trend followers and say, no, if that's going to happen, I'm going to put stops in and I'm going to go to cash and wait for a rebound. Yeah. But just being able to ask questions like that.
Yeah, a really cool question that we put out in our daily brief yesterday, which is free to subscribe to, is how does the market react to Fed rate cuts? And what we saw was that the S&P 500 on a 6-month horizon, typically falls following falling rate cuts. And then we showed you what were the best performing stocks, the worst performing stocks. So again, being able to pull up that insight with no bias, right? Just pure data showing you actionable insights.
Yet another reason why I tell you guys not to watch the news. Karan, how can these folks be in touch now? Most of them probably won't want to subscribe to the pro version like I do, but you do have Copilot. And I know that I do have a few clients. I think it's $150 a year or something for it. It's a reduced data set that's available. But if you want to learn how AI is affecting the financial services industry, you might, get it for a year, but the newsletter you said is free, right? So
the newsletter daily is free. We write about different topics in the market. We supplement all of that with the research that we generate. And then I guess if you're investing through Charles, who's at the forefront of technical innovation, you're in good hands.
Well, I appreciate that plug. So guys, Toggle AI is the URL. Karan Kumar, thank you so much for being here. This has been great. Really appreciate it. They have this new iteration called the Terminal, and when it is fully released and we've worked through all the bugs that we say, we'll have Karan back on and talk to you more. But it's really exciting. Thanks for being here, buddy. Really appreciate it.
Thank you, Charles.
All right, guys. All right. Hope that was interesting for you guys. So let's see. Let's go back to, here we go. U.S. policy. All right. Hey, Kate from Georgia. Yeah, I thought it was amazing too. So, as you know, policy is what we care about, not politics. Politics leads to policy, and that leads to personal impact. All right. That's important. So what does it look like politically right now? The only thing anybody's talking about is the election. Okay. So we have one president in office who has a son that's now a convicted felon. We have a president that was out of office or is out of office who is also a convicted felon who could be sentenced to jail time on July 11th. There's just been nothing like this in American history. Plenty like this in Venezuelan history or Iranian history or Afghanistan history, but not here in America. All right. So you can see what's happened since Election Day and then since Inauguration Day on this chart. Obviously, Trump's had a little better time up, but then that big drop off during COVID came back. So we'll see how that blue line finishes as Biden's term finishes. This is what it looks like for the last 6 presidents. And you can see that, no, it wasn't Trump's tenure that was the best. It was actually Bill Clinton's, which was, interestingly enough, the last time that we had a balanced budget in America. Yes, 30 some years ago. Hard to believe. The last time we had a balanced budget might be the last time in my lifetime, because we're nowhere close to that now. All right. So what is interesting to me about this is where people put their money. So I tend to think that you can read polls all the time and people say whatever they want to slant things, but When people actually put money on the line and bet, that to me says we've got some inertia going in the direction of a candidate. Betting is illegal in this country. You can see it on the top line there. But the current odds in the two biggest betting companies, and these are out of England, Donald Trump 51-45 over Biden. Look at Gavin Newsom there at 8%, and he's even higher than Robert F. Kennedy. It's amazing, all right? And then in covers.com, we've got a much bigger spread, 58-42. Michelle Obama at 6.7. Again, Robert Kennedy, he's not going to win, but he could take votes from either side. We'll see how that plays out. And I have to put this on the screen. Those of us that live in Illinois, I mean, this is just crazy. Why in the world can we not get fiscal policy here at the state level? And I hope that you're listening to us. I know we're from all over the place. We've got an Ohio in there at 57 cents. We've got a South Dakota at 48 cents. And here we are at 85 cents, second only to California. Throw the bums out. There's no reason to have these kinds of gas taxes. I mean, they're taxes that are being spent on all kinds of programs that we probably are not benefiting from. So just be aware of that. The Fed, of course, this week, very much in the news. At Wednesday's FOMC meeting, the Fed held interest rates pretty steady, signaling it's likely to cut less than the market wants. And yet, I saw Jay Powell look more cavalier than at any other time I've seen him. And I think it's because they know what they're doing is working, and they're not going to give in to market or media pressure to lower rates when they don't think it's time yet. The Fed sees higher unemployment in 25 and 26. Now, if that is the case, that's a reason to lower interest rates. It seems to me the Fed is saying 1 to 3 this year. I think they really believe it's 1. I think it's going to be 2. I think we're going to see 1 in September, and we may see another one in October. The next Fed meeting is actually after the election, so we'll see if something happens there. There's only one that can really influence the election, and that's the September meeting. So we'll see. Continue to believe, though I do, that the economy is headed for a moderate recession and a soft landing. I'm not totally in agreement with many other bigger firms out there that are projecting more risk to the economy. We'll get to that in just a couple slides. So major central banks around the world are looking at this and saying, all right, what do we think here? Well, the Bank of Japan and the Bank of Canada and the ECB cut rates this month, all right? And yet the European Central Bank, that's, all right, separate from the Bank of England, obviously. We held off because of stubbornly high inflation. Well, we've seen, or we will see when we get to the inflation section, that we really haven't had as much stubborn inflation as we have had in previous years. Sorry, guys, here we go. Or in previous months, like 12 to 15 months in reverse here. So the Bank of Japan reversed 8 years of negative interest rates, raising their policy rate and considering further tightening. So we're in a situation right now where we have some banks considering tightening, some considering easing. And again, that creates some uneasiness. Sorry for the pun. But when all the banks are moving in lockstep around the globe, lowering interest rates by a quarter basis point each time they meet, that's the kind of quietness that traders like to see, and they step up with more cash, okay? How long will this last? I do not know. The employment scenario, as you know, we show this program on the second Thursday of the month because the first Friday of the month is when the non-farms payroll data is released. Employers added 272,000 non-farm jobs. That's a good number. The estimates were 190, so that surpassed that, even though April was revised. Now, you guys know from watching the show that they initially introduce job information as they do GDP, as they do CPI information, and then they go back and revise it for the next 2 months, and then they start over again in the next quarter. So the unemployment rate rose to 4%, just 0.1% higher than April's. And many of these jobs added in healthcare, government. I wish we didn't see that added in government, leisure, and hospitality. So in general, the employment picture is still strong. It is virtually impossible to have a recession when you're growing in jobs. It's just impossible. I've never seen it happen. I don't believe it can happen. I was sent this chart by one of our viewers, and appreciate this. I know it's tiny, but just look at the different areas. So The CPI number showed that all items for inflation were at 3.3% annualized, all right? So most of that is food, juices. Frankfurters are up 7.3%. Bacon, I guess that means, and I trade lean hogs, just for the record, full disclosure. And there has been unbelievable volatility in the lean hog market and live cattle, which I trade as well. So uncooked beef roasts. I mean, you just never know which areas of the economy are going to have these pockets of inflation, but it's not across all sectors. It's not across all industry groups. And because of that, that's why inflation can drift downward. So it pulled back in May. CPI did decrease 3.3. We're expecting 3.4, went down. And prices are easing for consumer staples, gasoline and groceries, but it's still been stubbornly high. So the producer price index, so this was just released today. I always have this chart, literally the day of the show. You can see dropped even more than the CPI. So you would think that would make the Fed happier, right? So on the left-hand side, you see the orange bar there. So we're dropping in inflation there. On the right-hand side, though, we're still near the highest reading since April. So inflation is stubborn, and the Fed is determined to see it get to 2%. They have two mandates. One is for full employment. The other is to keep inflation as low as possible with a target of 2.0. So our view here at CB3 Financial is that inflation relief has likely been delayed, but certainly not destroyed. And of course, data that sparks further inflation could cause downside pressure on risk assets such as stocks. We know that. That's why we have a very defined trade plan with stops in place. One single slide on the recession. Citigroup, I mentioned this earlier, not Citi, but I mentioned the concept that I sometimes disagree with the much larger firms that have their own perspective on when we're going to start a recession. All right, so Citi predicts that we're headed for a recession in the middle of 2024. I think that would be now, indicating that the soft landing scenario is no longer viable. I think that is mistaken. We will have a soft landing, and we're in the middle of 24, and there's no recession here. Raymond James, another big firm, legacy firm, if you will, predicts a mild recession in 2024 starting in the second quarter. Last time I checked, we've got 2 weeks left in the second quarter. There's no recession here. Their view is supported by indicators like the inverted yield curve and rising interest rates impacting certain companies. Guys, don't follow this. I follow what the market is telling me. That's how I trade your accounts. That's why you're getting the returns that you are this year, which we'll talk about in the last section. I only point this out to you to say that there will be people out here saying this, and they're doing this to get eyeballs. They just are. I'm not saying they're evil and they shouldn't be doing that, but they're really in the entertainment business, which is different than the education business, okay? And Bloomberg, CNBC, even Fox Business News, they all are prey to that, getting eyeballs. So a U.S. recession predicted by executives, economists, and investors refuses to arrive. It may come. Even a stopped clock is right, at least an old analog clock, right? Twice during the day. All right. So steady hiring continues to fuel this spending. Employers are adding jobs. I just mentioned that unemployment rate at or below 4%. We're not headed to a recession anytime soon. Only real economic indicator that I saw that really got my attention is that Americans are now paying much more interest on their mortgages, which would make sense, and as much as their other debts. So bills for consumer debt service hit a record high, as well as mortgage debt. Now, maybe the consumer is getting educated and figuring out how to budget their lifestyle, their deficit lifestyle, because they're back to borrowing. The savings that were accumulated during COVID have now dissipated. And so they're spending from credit. And I'm not a proponent of that. If you're a client of mine, you know that I definitely do not encourage that. I don't know any clients of mine that do that because I preach on it so much. But that's what Americans do. And it does drive the economy, but it's not a recipe for long-term financial success. I'm going to get a breath of air here and get a drink. Is any chat questions I missed here? Hey, Tommy, good to see you. And Kate, thanks for your saying you liked Karan there. I thought that was a really cool interview, too. Poor comparison of felons. Former president, son of a president. Okay, well, there are all kinds of opinions on that, Ms. Deb, but it is definitely, yes, you're right. One is a son of, and the other is, we'll see what happens in the trial in September, right? Because there could be implications there of the current president. But I think it'll be pled out. Honestly, I don't think that trial in September in LA is going to even happen. I love the 43 cents for Kansas and Missouri. Yes, so this particular viewer of ours, client of ours, toggles, if we will, to use today's word, between those two states. And yeah, some states are just more fiscally responsible than others. And I wish ours were one of them. And if you live in a state like David does or Deb Domagowski does, who's on the line here, that's great. It just means you can spend money on other things that have value in your life rather than taxes. So speak to your congressman. Okay, 3 programs, the same ones you guys know, just introducing to some of you that may be watching for the first time. So this is CG. CG stands for Capital Growth. We're up higher in that. This is from 2 days ago. I was at a busy schedule this week, so I didn't get yesterday's data, which was another lifetime high. But really strong performance. If you look under CTR there in the middle of the screen, you'll see Alpine, VST, and Dell. So those are the biggest contributors to the profitability of this program. Notice that those numbers are higher than the CTR on the right side, the bottom performers. So our winners are always targeted to be bigger winners and smaller losers. And because of that, we have a lot of small losers. I'll get to that in just a minute. We had a viewer question on that. This is a trailing year, so it doesn't always look like this where we just kill it the whole year. We're the blue line. This is CG. This is actually my benchmark account, actual account at Interactive Brokers. Got behind last year in 2023. Our stop loss program kicked in, protected further downside, but then the market jackknifed back up, and we caught back up. As you can see, the blue line here. That's the methodology. That's how it works. And in a trailing year, we're back to outperforming the S&P. So this is, as you know, TraderSync. So this is how we log our trades. You guys have seen this many times. Look at the return on winners over the past year, 130 grand versus 70,000 in losses. Biggest profit, 11.5. Biggest loss, 2,200. So if you look on the right-hand column, and it's probably pretty blurry, but you can see all the winners there. And I'm going to show you the losers on the next screen. But the point I'm trying to make is the winners are much, much larger than the losers. And that's because the profit loss ratio, you see the 3:1:1 there. We're at a 3-to-1 profit to loss ratio. But what that does mean, and this is where this user question, which I'm going to handle at the end of the webinar here, is our winning ratio right now, 37%, is among the highest I have ever had. Normally, and certainly in GI, we're around the 33 to 33.5% range, but it still means way more of the trades are losses. So how can we sustain ourselves that way? The answer is in the center of the screen at the bottom. The biggest percent profit, 161. The biggest loser, minus 35%. This is where I have to go on camera and say, well, you told us you don't risk more than 1%. 1% of the portfolio might mean a 30% loss in a stock that's trading at $6. Okay, so price weighted does have bearing here, all right? So on the loss side, you can see the losses over here. My worst loss, since we've been tracking in this system, is Wolf Camera. November of 2022, so approaching, coming into 2 years there, and we haven't exceeded that. In fact, the next loss is just $500 less than that. So our methodology is working without a doubt. You can see that we're holding, look at the bottom there, total winners 81, total losers 136. So this user's question, and again, I'll handle it at the end, but I just want to mention here, was saying, I see all these losses on my account. Like, you buy a stock at 100, you sell it at 98. You buy another stock at 95, you sell it at 91. Why aren't we just holding until it turns around? Well, we don't know that it's going to turn around. And the methodology of CG and GI, not DS, that's a buy and hold system. But the methodology of those two programs is to take a stop when a stock is not performing the way we expect it to. And that's the way the methodology works. This is GI, which until this last 2 weeks had never had a day below the S&P 500. And there's only 60% stocks in this. The rest of it is fixed income. Okay, but it got a little bit behind. It is behind now in the S&P, but remember, it's trying to compete with the S&P with only 60% of the octane. So we're real happy with GI. DS, which has that 16% position in NVIDIA, as well as other AI stocks, and the Magnificent Seven having a good year as well. You can see the blue line. And we are back over 300% for a 6-year track record, approaching 7 years. On September 12th of this year, we'll have a 7-year track record in DS. It's volatile. Look below on the CTR. Microsoft, 49% return. Apple, Amazon, and yet the losers, you can see, are also larger. But the point is that we hold stocks in this program without taking stops. And you can't have that much money in it. I've said on this program before, the largest position anyone has in this portfolio of their total net worth that I manage is our own portfolio at now 13% of our net worth. But I don't have a single client that has more than 10. And that's a number that I'm sticking with because it's just very volatile. It can go up and down just as easily as the other. Okay? You guys have seen this, but it's important that you understand that when a stock draws down, like on the right-hand side, you're having to sit through this. It's one thing to sit through this when you're 35 or 45 or even 50. It's another thing when most of us on the line here are in our retirement years and we don't want to see this. But look at the return if you just buy and hold, okay? $18,000 from a $1,000 investment on the left side. You can see that. But here's the similar chart, all right, on the left-hand side, but now we're taking stops. Now, the actual trading methodology is not something I'm talking here, but what I'm doing is you can see the drawdowns are less. 23% in 2009, 25%, almost 25, 24.5, I think, in 2023 when we had that pullback in the autumn of last year, which you saw manifested in CG. So most people are saying, you know what, the 18,000 is nice, but I'm fine with this becoming, 11,000 with a $1,000 investment and being able to sleep better at night. That's why we have the methodology that we do. And that's why when you see those many trades on your statement, they're all going to be losses. The little trades, relatively little, they're less than 1%. I mean, they just are. All right. So it's very easy to say you could handle this drawdown if you're at a younger age, all right? But at our age, most of us on this call don't want to have those drawdowns, all right? It's not so easy to keep the faith when the chips are down. No pun intended with NVIDIA there. So it leads to bad emotions and decisions, and that's why we make the decision for you to get out of the losers and hold on to the winners. So if you can stomach these big downs and you believe the future is going to be a lot better, then you should have a DS account. I'm not saying everybody should, but most people should, as long as it's small enough relative to your net worth. And that's where we put on our wealth management hat and help you decide how much of your net worth should be exposed to such a volatile program. Let's face it, everyone would like to make 300% in a 6-year time frame with the same kind of risk that you have in, say, a government bond. Nobody would take the other side of that trade, though, right? I mean, every trade that has a buyer has to have a seller, and nobody's going to sell you that portfolio because there's no upside for them, all right? All right. So buy and hold works for, some situations, but we're going to suggest that you don't do that unless you have certain risk capital. The past performance is no guarantee of future performance. And that's when we sit down, especially with you guys that are clients. And we know we have clients and just regular viewers. But there's two hats to be worn here. One's the portfolio management side that says, no matter what you've got in your personal life going on, we're going to trade CG this way. We're going to trade GI this way. We're going to trade DS this way. I'm going to trade my speculative program a certain way. But on the wealth management side, and as you know, we do both for you if you're a client, we're going to allocate your proportion into each one of our programs so that it fits your personal risk profile. So in that sense, every single client has a different risk profile and ultimately then a customized portfolio that's just for them. Next month, super excited to introduce you to John Fotten. So this is a client of ours. I've known John for, 12, 14 years. He is an engineer with Sequential One, and they are in the cyber security business. So it doesn't do much good to have all this great technology if someone comes in and your data is exposed and your identity is stolen, etc. So John is an expert in this area, and we are super excited to have John on the show. Bring your questions. It's going to be really interesting. So there we are. That's it for tonight. Again, watch the show back if you want to see Karan's interview. I know for a lot of you, there was a lot of technology in there, and you might want to watch it a second time. Just know that we are using that every day, maybe not Sundays, but 6 days a week. With what's going on with Karan. I am beta testing for them like I have done for many other companies. So we're right on the leading edge, what some people call the bleeding edge of technology, using every single morsel of harnessed AI technology to make the very best selections. Again, this is a selection process. And then once we make the selection, then you guys already know what I'm doing risk management wise. And that's been fine tuned with the other market wizard, Tom Basso and I. And we think that's working really well. But selection process, different markets, asset groups, where in the globe we want to invest. As you guys know, Interactive Brokers, especially you guys coming over from LPL, and there's a lot of you, like 27 so far. But the point is that I'm having you sign up for every single stock market around the globe because Interactive Brokers trades in 135 markets. We're only going to pick the top 27 or so, 28 to trade in. But one of the great things about Toggle is it's going to allow me to scan all over the globe more easily than I was able to do. So next show, I mentioned this earlier, Thursday, July 11th. I hope you guys have a great 4th of July. Always end the show with this: for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. I hope I've communicated that we first started covering AI, and I want to thank one of our viewers, Larry, if you're still on, who said, you really should check out this AI thing. I don't know how long ago that was, Larry, but wow. I was a little behind the times, and I hope I've caught up now and keeping you guys up to date with essentially what is going to be a humanity-changing technology. The internet was that. You can argue that cell phones have been part of that. But this really changes the knowledge base, and it's not something that you need to be scared of. It's really not. It's exciting. We're living in a time that no other person in the previous centuries could even have fathomed what we have at our fingertips. We're going to take this technology, we're going to harness it, we're going to use it to your benefit to give you the highest risk-adjusted returns on your portfolio possible. Before I hang up here, thanks for the well wishes. Martha, Tommy, Larry, Deb, thank you. Both Debs. You guys are awesome. Please remember that at CB3 Financial Group, we don't just manage your assets, we become one of them. Happy Independence Day. We'll see you next month. God bless.